Good afternoon. Welcome back for a market update. Today is Monday, May 2nd, and we're coming off one of the worst starts to the year in history. I feel like a recurring theme in these market updates this year has been traveling back in time to revisit similar market and economic action we've seen so far this year. Despite the tough equity markets, in general, folks have been great at withstanding the sell-off. It's the bond sell-off that's been the greatest challenge, as we typically rely on bonds to provide that ballast for diversified portfolios during periods of stock market volatility. But this year, they have not protected. As challenging as the environment has been for all investors this year, that challenge is in the past. It's history. We've already tolerated the drawdown. So what's most important is the path forward. So let's try to put some context to it. First up, GDP, gross domestic product, which is the flagship measure of economic growth, was released late last week. And to the surprise of many, it was actually negative at minus 1.4%. But let's take a closer look. Again, with all these economic indicators, there is the actual number, which is called the nominal, and there's the inflation-adjusted number, which is called real. Most of the time, we see GDP discussed as a percent, which is actually the quarter-over-quarter comparison. But let's step back and look at nominal GDP, so no inflation, since 2007. This is the total number, not a comparison against the prior quarter, which I think we get hung up on a little too much. Here's the real or inflation-adjusted GDP since 2007. Same as the prior chart, just with inflation. Now let's zoom in a bit. Same GDP numbers, this time since 2019. Nominal without inflation and real with inflation. If you take out the COVID period, it looks to be more or less on that same trend. But I thought GDP growth was negative last quarter. Well, the headline number that gets reported is the real number, but nominal GDP actually grew at 6.3%. We'll have to see where it goes from here, but certainly with strong consumption and strong corporate earnings, at least from last quarter, the economy appears to be on decent footing. Next, financial conditions. This particular index is by Goldman Sachs and is basically an average of interest rates, stock market valuations, and a few other components. This chart here is that index relative to its 5-year average. We can see here that, yes, financial conditions are tightening, but what does that really mean? When we put the financial conditions index in blue compared to inflation as measured by CPI in orange, we can see that there's often this inverse relationship between the two. Essentially, over the past couple decades, tightening financial conditions, the blue line moving higher, has tended to eventually coincide with downward moves in inflation, denoted by the orange line moving lower. Question is, how much and how fast do conditions need to tighten to put pressure on this multi-decade high in CPI inflation? And look at this, personal savings rate in orange, CPI inflation in blue. As government transfer payments have slowed back to pre-pandemic levels and inflation has surged, personal savings rate is back down to pre-pandemic levels. Inflation, inflation, inflation. Have you ever heard of the magazine indicator? It's actually a contrarian indicator, meaning when you see something on a magazine cover, it often signals the end of a trend or the opposite of what's going to happen. Here's Bloomberg Business Week from April 2019, signaling the end of inflation. And here's The Economist from last week, announcing the failure of the Fed due to the relentless jaws of inflation. We'll see. And like everything else, the contrarian effects do not happen on a clock. But throughout history, we see many examples of the magazine indicator at work. Turning to the stock market, now that we're in May, you're likely to hear the phrase sell in May and go away. So we wanted to provide a little context for you in case you get caught up at the gym, a cocktail party, or what have you. If you start measuring in 1950 and look at 6-month periods starting in each month of the year, it's true, the sell in May period was the worst of them all, with an average return of just 1.8%, while November to April was the best 6-month period. It's just math. However, looking at the past 10 years of May through October returns, the average return was substantially better than the average since 1950. So when you hear someone say sell in May, you can say not so fast. And just to put into context how bad this year has been so far, the S&P 500 just had its worst April since 1970 at down 8.8%, and in fact, one of the worst ever. And through the end of April, this year has been the worst start to a year since 1939. Truly historic. But is there any good news on the horizon? Well, let's look at the 10 worst S&P 500 returns through April. Here we are, as we just mentioned, one of the worst starts ever, but here are the other 9 other worst starts to the year. And the S&P 500 returned for the rest of the year, basically from today, the first day of May, through the end of the year. With such a small sample size, we shouldn't draw any life or death conclusions from this. But the point is, the market certainly can and often does have a positive return from this point forward. All that said, we commend you for withstanding this historically bad start to the year. Not even just in stocks, but also in bonds. We admire your resolve and your focus on the long term and your dedication to your plan. Thanks for watching. Have a great day.